Mike Briggs is our market analyst this week. Earlier this month, futures prices for nearby live and feeder cattle contracts set new highs. December 2017 live cattle and January 2018 feeder cattle each peaked on November 3rd. But both ran into the wind Monday, responding negatively to another bearish supply report. The U.S. Department of Agriculture's latest cattle on feed report showed a 6% increase in the country's feedlot inventory compared to a year ago. And for the 9th time in 10 months, placements were higher than they were in 2016. We talked with Mike Tuesday morning and began by asking for his thoughts on November's report.
Well, it's kind of what we've expected. It's kind of been a trend. We've been a little short on the guesses on the placements because we've been every single last 3 reports. I think we've been over on replacements, so it wasn't a big shock to see that again, that it was over the guesses. At least this time it wasn't over so big, so it didn't shock the market quite so bad. Marketings were still good as I anticipated. You know, as you keep having those placements, your cattle on feed, the on-feed number is going to get bigger, and that's just the way it is. So we're going to have plentiful supplies going forward.
Right, to follow up on that, the last 2 months placements were up double digits. So when does that start to impact supply?
Well, that's going to be after the first of the year. Well, not right after the first year, but as you go into spring, I think it's going to be pretty hard on us. May, June, kind of like it always is. I think you're going to see big supplies of cattle going forward. So I think producers are going to have to be real cognizant of their margin management, their risk management. Having said that, so long as nothing derails demand, we can just keep chewing through this just like we've been chewing through it. I don't know what could derail demand at this point in time, probably some wonderful outside influence, but I think things are going along pretty well. But the producer has to be really cognizant of the fact we're not in a short supply situation. We're now in a big supply situation. You got to go forth accordingly.
It's been an interesting month for market prices. We hit a high earlier this month, and now we completely fell off. Describe what happened.
Well, I think a lot of that's fund activity. The funds always push it too far in either direction. They rocketed this thing higher, and it was a little hard to figure out, although you've seen really excellent export demand. And demand in general has been really good, so you can kind of understand it, but then when it hit, the way it peaked and dropped here and basically took back the whole rally, that's really shocking because not that much has changed, but that's what happens when the funds are in that market. They push it all over the place. Now, having said that, I don't think that much has changed. I think your fundamentals are secure enough here that hopefully, now yesterday the market went down, and if you looked at a bunch of charts, we hit a bunch of moving averages in every single month and on the long-term charts. So now today we've had a little bit of a recovery. If cash can be steady, that really makes this market kind of hold in, and we can see it gain back something. You know, how far it can go, maybe you can go back to the old highs. It's going to be really demand dependent. We ran into, the cutout kind of ran into a brick wall here last week, and that gave the market a little impetus to go down too. And it kind of felt like that peaked a little early because usually we have really good demand going into maybe the middle of December, maybe even a little longer than that. And it kind of hit a brick wall, so that was a little bit concerning. But as I was reminded yesterday, packers don't always have to make money. And we've seen long stretches where they didn't, and they've been making money with both hands. So maybe it's time that we can leverage a little bit away from them, and the retailer leverages a little bit away from them. They won't like that, but maybe that's what's actually going to happen here.
What has their demand been like, the packer?
Packer demand has been excellent because they've been making so much money. When they're making in excess of $100 a head, they're gonna harvest cattle, and they've continued to do that. The other thing that's been good is because demand has been good, they've got stuff sold out front, so therefore they have to buy cattle to fill those out front orders. So from those standpoints, that's really good for us as we go forward. Now, a lot of the analysts are trying to talk about how, oh, we're going to have a big supply drop after the first of the year. Well, the market's kind of taking care of that, because if you look at that spread between December and February, that's going to pull cattle out of December into February. It's pulled a bunch of mine. I've already contracted them for January because that was such a huge spread. It was just a gift. So that's going to smooth out some of that alleged drop in supply. But because that's there, I just think demand is good enough and things could keep rolling here. I think this break was way overdone, is what I'm saying.
Finally, a look at feedlot margins.
They were really good in October and first part of November. They've kind of taken all that away. I think, you know, but if we can sell cattle 118, 124, everybody's going to be fine. You know, and I don't think there was any break-evens where people were buying 127, 128 break-evens. I know there's a lot of break-evens in the 120s, so, you know, maybe those cattle don't make very much money, but as long as you're not getting your nose bloodied, you're all right.